on in the last leg of the show where we take your queries and have it answered through our experts. And today I have Amol Joshi, Plan Rupee Investment Services. Amol, good evening and welcome to the show. I have our first viewer online who wants to ask you the question, Amit Kumar Nigam from Delhi. Hi Amit, good evening. How are you doing?
Yeah, hi, Kavita. This is very fine. Thank you for taking my query on the live show.
Thank you so much for sending us your query. Okay, so I believe it's on the latest issue, impact of TER on mutual fund return. Is that what you want to ask?
I want to add just only one thing. Is the
Sure.
latest recommendation of SEBI of TER. What will the impact? What will be the impact on the mutual fund returns and the AUM of the? And do we have to check actual AUM of the mutual fund before investing? As the new norms are coming?
Sure. Okay, we'll get that answered. We'll understand the current scenario, and also if few of these proposals get actually formalized, what will be the outcome on your mutual fund return. Thank you so much. And Amol, over to you. What's the existing pattern of TER?
First, understand what TER is. TER is total expense ratio. This is the kind of expense that schemes or fund management companies are allowed to charge to run your mutual fund scheme, to manage your mutual fund scheme. Now, broadly, there are multiple categories of mutual funds, but broadly, you can divide them between 2 or 3 categories: pure equity funds, pure debt funds, hybrid funds, and so on and so forth. As of now, equity funds have a TER cap of 2.25%. Now, coming to the question, what will be the impact of TER? The impact will be very simple. All the measures taken by market regulator SEBI, mutual fund regulator SEBI, have been investor facing. In the sense, there has already been a downward revision of TER sometime in April 2020. And going by the look and feel and the language of current draft proposals, it looks like that the TER will be further rationalized. To answer it in one line, if the TER gets rationalized, if the TER gets lower, the customer benefits because it boosts the returns of the schemes to that extent. That's point number one. And I think Amit also asked the second question, what will be the impact on AUM? Now, if the returns go up, if the cost of investing into a mutual fund goes down, consequently returns go up, then I would say that there would be more and more flows coming into the industry. So the impact on AUM will also be positive. In other words, AUM is likely to go up as the new regulations take shape the way we are looking at them.
All right, Amit, is that clear? Do you want to ask anything else?
Yeah, that's sufficient question actually. Thank you so much, ma'am.
Thank you so much, Amit. And we move on, and let's move on to our email query, which is from Raila. And I think, Amit, you have that question. Amol, you have that question on you. Raila says that she is new to mutual funds and she wants to choose index funds over small cap or mid cap. She wants to ask if she wants to know if that's the right strategy for her. And she also says that she has a higher risk appetite. Now, that's a very interesting question because when we talk about passive investment, we just covered a discussion where the passive ETFs have cut down, specific passive ETFs have cut down their expense ratio. So maybe you can touch upon that point also in your explanation, Amol. But then, yeah, if Raila has a higher risk appetite, shouldn't she be going the active route?
All right. So if Raila has a higher risk appetite, the rule of thumb says that she can probably look at or she can opt for mid-cap and small-cap funds. And mid-cap and small-cap funds over a long period of time, it has been seen that these funds are able to beat their respective benchmarks. So you're right, Kavita, here that she can probably look at actively manage mid-cap and small-cap funds. But that is only one part. Raila also mentioned that she's a beginner and her question was framed in such a way whether I should look at index funds or I should look at mid and small cap funds. Now, these two are not directly apple to apple comparison. Let me tell you that there are also index funds in mid cap and small cap category too. In the sense, you do not have the binary choice of whether index funds or small cap, mid cap. Within mid and small caps also, you can opt for index funds. So I would say as a beginner, you're probably your best bet is to probably go with Nifty index fund. And as your expertise, as your understanding of the investment instruments and your own risk appetite, if you are a beginner, I hope when you conclude or when you communicate to us that you have a higher risk appetite, I hope you have done the proper exercise of assessment of your risk appetite. If not, then as your understanding and risk appetite truly grows and as you gain the market experience, later on you can always opt for mid and small cap funds. But to start with, as a beginner, your best bet is the Nifty index fund. That could be your choice, Raila.
But then going forward, if she wants to diversify her portfolio, what should be the exposure, maybe in a large cap, mid cap, or small cap? Because I don't know how old is Raila, and although she's mentioned that she's got a higher risk appetite, it should not be the case where she lands up investing a lot in a small cap and a mid cap category, which usually people land up doing, because they want higher returns and quick returns. That's what they think.
Right. This is a very important dimension that you have brought out, Kavita. Now let's also look at the other parameters. Like when you say higher risk appetite, choosing equity asset class itself, you are going towards a product that has a higher risk involved in it. If I just take you back in time 2 or 3 years, during the COVID crash of March 2020, the mainstream indices, that is Nifty and Sensex, over a few weeks saw a crash of about 35%. So that is a significant drawdown for any person, no matter what your risk appetite is. So choosing equity itself, you are probably fulfilling a large part of your higher risk appetite and ultimately, wanting to gain higher returns out of it. Coming to the crux of the question, what is the kind of mid and small cap exposures you should have? Since some of the aspects like investment horizon, age are missing, let me give you again a rule of thumb kind of an answer. I would say a multi-cap, large cap, flexi cap exposure together, or in other words, large cap exposure together should be about 60%, and about 35 to 40% can be into a mid and small cap. Within that also, small cap should be comparatively lesser. If you say 40% is your total exposure to mid and small caps, I would like to place mid cap exposure at about 20-25% and probably 15% into small cap. So 60-40, and within 40, 25-15 is the way to go.
Right, that's the suggestion coming up for Raila. And on that note, thank you so much, Amol, for being on the show and helping our viewers with their financial portfolio. And time to sign off, but then I'm going to leave you with our WhatsApp number and email ID where we are expecting your questions that will be answered by our experts. Thank you so much for watching. Goodbye.